Shares and bonds. Investing in the stock market can be a very good way of building a large fund. However, the stock market is volatile, and there are many stories of investors losing their money because they sold their stock or shares at the wrong time. As a short-term investment, the stock market is perhaps best avoided, as there is much to know about managing your stocks. But long-term can be rewarding. A share, in financial terms, is an equal portion of the capital of a company. When investing, you buy a number of shares at a particular price, say $2. You may buy $1,000 worth of these shares through a bank or a stockbroker, so you hold 500 of these shares. Now, let's say the company does well, as shares are traded daily and their value rises. That is, other shares in the same company are sold for $3 each. On this day, your stock will be worth $1,500. What you could do is sell them at this increased price, and you have made a decent profit. As a long-term investor, a quick turnaround on shares is inappropriate. Yes, you could sell them and buy more shares at a cheaper price and hope that they rise in price. If they do, you are doing well. But the value of shares can go up as well as down for lots of reasons. If you sell at the wrong time, you could lose money. If something particularly bad happens in the world economy, so how do you invest in shares without losing your shirt? Firstly, you ride out the highs and lows of the stock market by keeping your shares for as long as you can. If you look at a graph of the performance of the market for the last 30 years, there will have been many daily highs and lows, but you will find that the general trend is upwards. This means that if you have shares in only one corporation, you are very vulnerable to each rise and fall. All your eggs are in one basket, so to speak. Perhaps a wiser strategy would be to buy your shares across a range of corporations. This way, when some are down, some may be up. This way you stand a much better chance of making some money. Spreading the risk by buying a range of shares is exactly what investment companies do. A range of shares is called a portfolio. An investment company can help you to decide on the contents of your personal portfolio. In addition, they can offer you investment packages in which they manage the buying and selling of your shares for you. Bonds are another investment vehicle. They are a bit like a loan that you give to an organization, with the promise that they will give you back the money with interest in the future. In finance, this is called debt security, where a security is a term used to represent ownership, stocks, or a debt agreement, bonds. Bonds are generally issued for a fixed term, the maturity, usually for 10 years or longer. The U.S. Treasury issues bonds with a maturity longer than 10 years. Other organizations normally use bonds for large issues offered to a wide public. Large organizations issue bonds to raise substantial capital. In terms of risk, they are relatively low. Bonds and stocks are both securities, but the difference is that a stockholder owns part of the company they are investing in, whereas a bondholder is providing a loan for a fixed term. The most important feature of bonds is the nominal or face amount. It is the amount on which the interest is calculated and the amount which has to be repaid at the end of the term. also called the maturity. The issue price is how much the investor pays for the bond, and the maturity date is the date on which the issuer has to pay back the nominal amount. There are many types of bonds. Fixed-rate bonds have an interest rate that remains fixed throughout the term. High-yield bonds are relatively risky, but investors can expect to earn a higher yield. And inflation-linked bonds have the principal amount index-linked or tied to the rate of inflation. Check the web for further information.